Hi everyone, my name is Adam Harris, and yes, I'm here to talk to you about breaking down 5 trading myths that I think that traders must learn to ignore. And today we're doing part 2 of 5. There's quite a bit to talk about on each one, so I've broken them down into individual videos. And so what we're going to do in this particular session is kind of talk about, I'll get to the title in a moment, but I want to produce a series of videos because I think that there's so much misinformation and so much disinformation out there that the process for learning how to trade the financial markets is already messy. I mean, it's not something you can go to university and learn how to do. It's kind of like a professional sport where you might have to, you know, if you wanted to pick up golf, you'd have to go to the right kind of person to teach you how to do it, or surfing. It's more of a skill that we want to pick up in that sense. And actually, the thing is that breaking it down into the core elements that are important to do would not require 3 years at university. It doesn't require that, but there is a certain amount of practice that's involved. So again, as I started off the last video, this is just a reminder that a trading strategy is effectively just a written description of a visual pattern that occurs frequently in the markets, and that if executed faithfully, if we put our entry in the right place, our stop loss in the right place, and we take profit regularly, it's just much more likely to unfold in our favor than go against us. Okay, that's the essence. That's the thing that I just want to keep repeating, putting in your mind so that you understand that. I need to actually rewrite that so that I read it exactly as it says there. So point number 2 of the first 5 trading myths that I feel need to be busted. The second one is the idea that trading only 1 or 2 instruments is maybe the key to success. So perhaps we approach someone who says they've been trading for several years and they say to you, well, I only trade euro dollar. That's all I do, and it's worked really well for me. Or I only trade the DAX, for example, or maybe the S&P. Okay, so there should be a real reason for it. There should be a valid reason for it. They should be able to explain to you why they do that. And yeah, in many cases, you could say, for example, I'm trading the US Open, which is usually when there might be a gap and we can trade the gap each day. But even in those situations, you might want to you might want to participate in a gap on the NASDAQ as well as the S&P, as well as the Russell 2000 or perhaps the Dow. So trading only 1 or 2 charts is, for me, doesn't really make sense. Okay, so let's get into this in a little bit more detail. Many new traders believe that they should only be focusing, and these are just examples, that they should only be focusing on the Euro, US dollar, or the DAX charts, for example. That's almost always because somebody who has been dabbling, and I'm using the word dabbling appropriately, in trading for however long, has told them that. So they got the idea from somebody else. It's very rare that an institution would say only do that. And I also think that it's also very rare for a trader who's been working for institutions would only say that. So the belief is also that these charts offer good trades every day. So an example is Euro US dollar. The belief is that it's highly liquid and that it has the most action or the most volatility. And volatility in this context refers to energy and motion and kind of movement, because we need price to move in order to benefit from changes in price by trading that. The thing is that actually there's 10,000 instruments out there that have more than enough liquidity for most of the retail traders on the planet. So liquidity isn't really a good enough excuse, I don't think. And actually having movement on any given day, I've seen euro dollar do, excuse my language, but do sweet fuck all for several weeks, if not even months. And so except be extremely volatile and be very choppy. So I'm not convinced that that is justification for doing it. All right, so the belief is also that these charts offer good trades every day. This is a very important point that I want to make. They never question whether each day, or there could be an extended period of time where the market is, or that particular instrument is basically untradeable. There's just this belief that somebody has told them, no, every day there's going to be a trading opportunity or several trading opportunities on it. You just have to be there, which means what that does is that forces traders to look down to the 5 minutes and the 1 minute time frames to find these trading opportunities. And so it forces newer traders with very little experience into very high pressure, fast moving situations, which is not good for them. And there's only so much beating you can take as a new trader before you just decide to pack it in. And I think that you have a range of different, in fact, I'll do a series on it at some point about the different types of traders that you get out there. Okay. And the experience gained, so the next point on the list is that the experience gained from focusing on one chart will remove being distracted by other charts. So I'm going to address the problem with them. Okay, so point number 3, what individuals get into their heads is they think that if they try to look at too many charts, they will either miss opportunities or be distracted. So, all right, that sounds like a fair point, and I'm going to address that in a moment. And just as I said, to go back to point number 2, the belief is that these charts offer good trades every day. And that just simply is not the case. There are days, possibly, when it's offering safer trading opportunities. And there are days when it's offering not so safe trading opportunities. In fact, it could even have conditions on a regular basis for extended periods of time where trading should be avoided entirely. Okay, so, and that's actually the reality of it. So often I'll meet someone, I'll be on the phone to someone who I know, as you meet people, and they'll say, yeah, no, I really think I'm about to give up trading. And then I'll be like, well, what are you trading? And I know they're going to say currencies. So I know they're going to come back and go, yeah, I've decided to just focus on currencies, and that's all I've been doing. But, you know, I have so many losing trades. And the thing is that people need to understand that currencies are much more prone to range-bound behavior than all the other instruments, because you have two separate economies pushing and pulling against each other. So you've got the euro against the US dollar, you've got the British pound against the Australian dollar, the Japanese yen against the US dollar. You've got two different economies. It's a tug of war. It's not the same as the other asset classes. And so ranging or seesawing is actually much more normal. I'm not saying you can't have trends. I'm saying that ranging is normal for currencies, but ranging is not normal for other asset classes. They tend to work more on supply and demand. Technically, what you have with euro US dollar, for example, is supply and demand of the US dollar as well as supply of demand of the euro. So you've got two instruments involved where you're kind of balancing the two as opposed to a single element such as gold. What is the supply and demand of gold? Okay, so the experience gained again from focusing on one chart will remove being distracted by other charts. The problem here is that, and I know this, we sit and we look at the 1 minute chart or the 5 minute chart, or we sit there watching this one single chart, just trying to determine where we can squeeze a trade out. Like, is there an opportunity here? Should I be counter trend trading? Should I be range-based trading? Should I trade the break of the pivot? Bollinger Band, like what am I going to do? And actually in those situations, we are exposing ourselves to, let's take any given month, we are exposing ourselves to multiple days where it's probably a good idea not to trade at all, and we haven't even considered that, so that's not even included. But not only that, while we're busy trying to squeeze like blood from stone a trade out of euro dollar, meanwhile, the S&P has been trending beautifully and providing multiple very high probability, very, relatively speaking, safe trading opportunities, 3 to 1s, 4 to 1s, 5 to 1s. And we're trying to squeeze blood from stone by focusing on euro dollar. Okay, so this is the reality of the situation. Okay, so what's the truth? Well, the truth is that focusing on only one chart guarantees that we will miss good, clean, safe opportunities occurring elsewhere. Almost always. Okay, there's stuff happening elsewhere. It's just assume that that's the case. It also assumes that the market conditions are good for trading all day, every day. So in other words, a beginner trader sits down, hasn't really had the good fortune of being mentored by a really seasoned, really good trader. And I think there are schools of thinking, schools of skills, and I think that there are rarely incredibly good schools of thinking that are out there. And you'll know it when you see it, but otherwise you just assume everything else is the same. So for me, I can immediately identify a really good trader when they talk about price action a lot, when they talk about things that make sense. If their stuff sounds like voodoo and mysticism, and and there's them and us versus the market, and the little trader always gets kicked out, and all kinds of other stuff, which just to me sounds like excuses for not doing well. Whereas a professional trader will talk about price action, key levels, because at its very core, that's what trading the markets is ultimately about. And keeping it really simple and talking about probabilities of success and not sounding jaded. All right, so not recently, but in the last 3 months, I was invited to sit in on a panel of speakers, and I happened to tune in to the speaker, to the tail end of the speaker before me. And man, this guy sounded like he was this far from putting a bullet through his head. And he'd been in the industry apparently for 20 years. And he was just saying to everyone, well, it's really dangerous and you shouldn't do it unless you're really sure. But he didn't sound happy. He sounded miserable. And he sounded like he had his own battle going on. In fact, if I didn't know better, I'd say that he had recently maybe given back a large amount of money to the markets and was feeling incredibly frustrated and just venting. That's how it sounded. And I was just listening to this and I thought if I was a new trader, I would have been incredibly discouraged. And that's not the way it is. This is a learnable skill. I believe that everybody should be engaged in learning how to trade the financial markets for either trading or investment purposes. In the same way that I think we all should have been taught how to do our taxes at school, I think we all should have been taught, accounting skills, the things that we really need to use in life. And I think this is one of those skills. So it also assumes that the market conditions are good for trading all day, every day. So a new trader sits down and their assumption is that every day is roughly the same, roughly. And I hate to tell you this, I hate to burst that bubble, but it's not even that every day isn't the same. Every month isn't necessarily the same. You can have, since Brexit was since we had the referendum for Brexit, Euro GBP has been effectively in a range since 2016. We're now heading into 2021. And so for 4 years, it's been stuck in a range. All right. And the markets today, the currency markets today, for example, are not the same as they were prior to Bank of Japan and the Swiss National Bank intervening into the currency markets around about 2013, 2014. They kind of did some real structural damage to the markets. And they used to, prior to that, Japanese yen crosses as well as the Swissy crosses were phenomenal for trading. And so people who's come into the markets after that have no idea that prior to that, trading was actually, I would argue, was actually better than it is today. I think today it's more frenzied. I think the market refuses to commit to trends for very long periods of time. And I don't think anyone teaches the newer traders that the market isn't the same as it used to be and that you can still do it, but you need to have a different understanding of how it has changed. In the same way the weather has changed, we've got global warming, that's a real thing, obviously, and in the same way the markets have kind of changed. They may very well continue to change and go back. There are many things about them that don't change, but I would say that they're prone to having currencies, for example, are prone to having shorter trends. And this makes sense because the whole world is sitting in general uncertainty, and that is reflected in the economies, and that's reflected in the currency markets. So do not assume that the market conditions are roughly the same every day, and therefore if you have a series of losing trades, it was just how it was meant to be. No, sometimes you have a series of losing trades because you shouldn't have been in the market, and maybe it's going to be that way for the entire week. Okay, so for example, you get a daily retracement. So you've got a beautiful uptrend and then the market decides to retrace, except that maybe what happens is instead of retracing cleanly, it kind of consolidates for a series of days. Okay, so a daily trend consolidating for a week means that entire week the market is going to give you mixed signals. It's going to have the buyers and the sellers battling it out because it's kind of going through a bit of a consolidation phase. All right, and so if you don't know that, if you're not looking at the daily, you look at the 5-minute chart, you're really not going to know what's going on. So you need context. It leads to dependence on news announcements, which is not good for technical trading. Okay, so I'm going to express this as my personal opinion. Okay, so a couple of things here I think would count as a general kind of the generally agreed kind of wisdom of trading the markets, and some of the things are going to be personal opinions that are mine, but I think they're based on experience, and I've not found enough evidence to kind of to scratch them, I guess, from the list. So there's a lot of talk about, okay, so what's Draghi going to say, and now Yellen's coming in, and oh, Trump did this on Twitter, and that's a separate video actually for another day. But the point is that then getting stuck on intraday trading means that we tend to suddenly start finding ourselves around the water cooler on the internet, talking to people about how this news announcement is going to affect this particular market, whether it's gold or whether it's the NASDAQ or whether it's currencies. And actually, when you rise above it all, if you're trading the much higher time frames, you're already effectively piggybacking on whatever that stuff is. And for the most part, there's less volatility on the higher time frames. So the logic kind of follows down that, yes, of course, there are spikes throughout the day, but for the most part, we should still actually be piggybacking on the prevailing trend, which is more evident in the higher time frame. So in other words, news announcements are not necessarily as important as we think they are. So I don't want dependence on them and reading too much in them. What we really should be doing is being aware of when there could be a high impact news announcement that comes out, so that we can either bank our profits or move our stop loss to break even or exit the market entirely before that happens. That's being practical. That's practical because we don't know what's going to happen in the news. Could go in our favor, could go against us. The whole point of being a trader is really about trading probabilities of success. You want to trade when you have confidence that it's almost certainly going to go your way. And when a news announcement is coming up, you can't really have the same degree of confidence. And I have a lot of people saying, yeah, but the numbers came out and the numbers were good, but then the market fell. That's how it goes. If the expectation is the numbers are going to be good and enough people think that, the market will price it in. So what happens is that by the time the good news comes out, the profit has already been built in, and then profit is taken, and then the market has a reaction the other way around. If the market doesn't really know what's going to happen, then there could be a response to the upside if the numbers are good. But if most people have already guessed the numbers are going to be good, it's already calculated in. So you must understand that most people are already educated. And it's not just that. Most people really discount the news a lot. I mean, a case in point is that when the US decided to start increasing their interest rates, which they hadn't done for 8 years, they started talking about that 6 months in advance in order to give the markets enough time to digest it and plan it. So by the time it actually happened, the reaction was pretty muted compared to what it could have been, because the market pretty much knew it was going to happen, and they pretty much knew how much it was going to be because they communicated that. So the market, in many cases, has already taken a lot of that stuff in. All right, so next one. It demands more experience in order to squeeze out profits from potentially messy conditions. I think that's pretty much what I've said so far in a lot more words. It demands much more experience. Okay, so in other words, it's not fair to newer traders to be able to navigate fast-moving markets and think clearly under pressure, because the market is so volatile and is moving so quickly and is so temperamental, and it's not fair to them to try to squeeze profits out. And nobody's told them this. I'm telling you now, but nobody else has told you this. I remember when I was learning how to trade in 2009, 2010, 2011, that when you'd have a really nice trend on the 5-minute time frame, and then we'd be waiting for the news, and then the news would come out, and the news would be positive, and the market would react appropriately to that news. So there was a lot of correlation, positive moves in the market with positive news that came out. It doesn't work that way today. You can have good news and a bad reaction, or a bad reaction or good reaction to bad news. I mean, it's bizarre, but so thinking that the news is some other key to success, again, I digress. That's a different topic. I'll talk about that another day. So next point. It can make the trader twitchy and restless, which leads them to take a trade for no real or valid reason. Because they think that they should only be focusing on 1 or 2 charts forever, because that's the secret to success, they end up going, okay, I've got to take a trade today, when maybe they shouldn't. And even if they don't take a trade that day, the next day they're even under even more pressure, because in their brains are going, look, I can't just not take trades. I have to take trades. So then they start looking for trade setups that are maybe weaker or whatever. And actually, possibly that whole week is going to be bad. And there are times, by the way, when you know the whole week is going to be bad. You know that if you're going to have a daily retracement, potentially it's going to consolidate instead of retracing, and therefore it can be bad because there is no prevailing trend at that point in time. So more importantly, they will likely participate in a market that is so volatile that they really should be staying away from it. And that's it. If you think about it as weather conditions, your assumption is the weather's the same roughly in the markets every day, and that it's unknown how the market's going to be that day, like what the weather conditions are going to be like that day. And I don't know how to tell you this, but that isn't the case. For example, when the euro currently, right now, the dollar is weakening. Okay, but it's also going through a bit of a retracement. Once it's done with that retracement in the next few days, most likely next week, it will start to trend again. And the weather conditions on the lower time frame will start to become clear. So what am I saying? I'm saying that I know that when the US dollar starts to resume its weakening trend, which it still has at the moment, once they head down to $90, when it does that, I know the trends and the market conditions on the daily charts, intraday, lower time frames, 5 minutes, 30 minutes, are going to become beautiful. I know that. So, and that's probably going to be next week. So I'm trying to tell you that to some degree you can predict reasonably what the weather conditions are going to be like on the lower time frames. And if you don't get that, we'll talk about that at the end. Negative volatility, which I refer to as choppiness, because there's a lot of words in this industry which are used and have different context. So volatility is a great one. Volatility in one context refers to energy. The market has got transactions going on and it's moving, so therefore it's volatile. Okay, so that's the good thing. You need a market with volatility as opposed to a volatile market, which means dangerous. You need a market with volatility in order to have movement, in order to benefit from changes in price, and that's how you make money. As opposed to a volatile market or a highly volatile market, which means it's too choppy, it's too dangerous to trade. Excuse me. So negative volatility, choppiness, and violently ranging markets can last for days. They can even last for weeks, during which traders will bleed losses. You'll be on the lower time frames. So in other words, you cannot see the forest for the trees. You're not looking at the higher time frames. And maybe you haven't realized that the daily chart is actually in a range and it's all over the place. And what this will do is cause you to have losing trades, cause you to doubt that you can do this, doubt yourself, hate yourself, revenge trade, do all kinds of strange things, which then leads to depression, which of course then spirals because now we're really not in a healthy state of mind, which then leads to further poor trading or risk decisions. Okay. So, I mean, I make the joke on the right-hand side, but this chart, for example, the DAX, the 2 hour, it's gappy, it's spiky, it's not looking good. We really shouldn't be trading that. And just because I like the DAX and I love the DAX and the liquidity on the DAX is something like 30 times the liquidity of the FTSE 100, it's insane, doesn't mean it's tradable every day. So what am I supposed to do then? Okay, so instead of me just bitching about everything, what am I actually supposed to do then? Well, understand, okay, that success comes from following the markets that are offering higher probability and safer trading opportunities. I put safer in air quotes because I mean that I don't want to say safer and then have someone say, well, trading isn't safe. It's never safe. I'm like, well, yes, there is risk involved, but there are degrees where it is safe by comparison. So if you look at the chart on the right-hand side, dollar Swissy in this particular situation is offering much safer, much more higher probability or greater higher probabilities or just greater probability trading opportunities than the DAX in the previous slide. The other thing you can do is take a break when you feel like what the hell's going on. The market just started moving down and then it just reversed and started going up and it's just acting all crazy. Take a break, look at other charts. That is a clue from on high that you should probably just not get involved with this and just go have a look at other charts. Look at commodities, look at bonds, indices, and equities. What's going to bug you, but this will blow your mind, is that when you find out, holy cow, this other chart has been trending like this and just printing money. What if I'd been involved in that? Zoom out. This is also a thing that I think you should do immediately is go higher. So it's an aerial view. Zoom out and view the higher time frames. Look at the daily chart. All right, you can almost always determine when you look at the daily chart what is going on. I'm going to show you, I'm going to go to the charts in a moment, so I'm going to show you that. And so you can get a sense of what's actually going on in the bigger picture. And when you see that, it'll at least give you an explanation. So maybe you've only had 2 losing trades, and then you're like, okay, that's why I need to stop trading. As opposed to you just keep trying to squeeze the trade out, and you're bleeding because you've taken 8 trades and you've lost 7 of them. Very important, of course, to identify key monthly, weekly, daily levels and check that price isn't battling up against one of those. I will talk about that in a separate video because that is probably the single biggest, most important factor in trading the financial market successfully. That won't make sense to you now, but it will when you watch the video. So before I go to the charts, this is something I want to kind of provide you with. What are your opportunities here? I'm looking for subscribers. I want subscribers on my YouTube channel. So if you click subscribe, first of all, so that you can practically be notified of fresh new content and live events, because I do live market scans, but you can be notified of these videos and you like at least 2 of them. It makes my time worthwhile. It's worth my while to produce the videos, to do them. And if you can get 10 people to do the same, all they have to do is literally subscribe and like 2 of the videos. That's all they have to do. that will get you an hour's worth of mentoring with me, which you can take in the form of 6 10-minute sessions or 2 30-minute sessions, whatever floats your boat, but you can do that. Okay, so I would recommend that you subscribe on YouTube. I'm also on LinkedIn, so because I provide obviously corporate experience as well, and obviously on Twitter as well, because everyone's on Twitter, I mean, obviously, but this is what I would recommend. So I should have said, yeah, I'm actually talking about subscribe on YouTube. I'm going to clarify that for the next video. So let's go to the charts. Let me go and show you this. So we'll go across and have a look at the charts so that I can demonstrate to you what I'm actually talking about. And this is what I'm going to do. I'm going to go across and I'm going to have a look at let's go across and have a look at euro dollar, and I'm going to wrap it up after that, I think. Okay, so when we have a look at euro dollar, all right, we have been range bound for quite a while. So we were kind of range bound during this period, and then we were sort of largely range bound over here, and then we started trending beautifully, really, really nice. And so we have a situation here. Okay, I've actually marked it out with price. With trading, there are usually 2 or 3 different ways in which the market can play out. That's it. It's beautiful. It's not an unlimited number of ways. Anyone who tells you there's an infinite number of ways of trading the financial markets is wrong. They're not lying to you, they're just wrong. And anyone who tells you there's an infinite number of ways in which the market can play out is also wrong. There is a finite number of ways in which the market can play out. I'm not saying it can't change direction. I'm saying that the ways in which it can respond are limited. So if I just draw on this for a moment so I can illustrate this, all right, so basically we have this really decent trend. What's important is that we have actually broken outside of this range here, and we're kind of outside of that range there. And a lot of this has to do, is driven by the US dollar. So euro dollar is climbing actually because the US dollar is weakening. So the problem is that we have a couple of different ways. One of the things I really like is that when price tests resistance, that it breaks out through the resistance, tests support, and then carries on. That's beautiful because that's a really good entry opportunity and it's relatively safe. Speaking, it's very high probability, but it doesn't have to happen. Here's the other reason why I'd really like to see that happen, is because we have a round number here. So it's not just that it's support and resistance, it's also a nice round number. Okay, so I'd really like to see the euro dollar come back down to this level, but it doesn't have to do that. So what does it actually have to do? Well, if we just go through it, so if I just kind of scrap this stuff and then I go back to it, there are effectively there's about at least 2 ways in which it can react. It comes back and connects with the moving averages and then carries on up to resume the trend. Now, why do I think that it's likely to carry on? Well, first of all, the market moves from one level to another. So it's broken through this level. The next really significant level, which is colored green because it's a monthly chart, so it's very significant, is higher up. So it's broken through 1.2. It's free now. It's been range bound for months, I think since June, July, and it's been range bound, and therefore now it's kind of free. So it really wants to take a run. It's been bottled up, traffic jammed, whichever way you want to put it. Now it wants to run, and therefore the next really big level is up here. So the probabilities of it going up to that level are very, very, very high. Okay, they're not 100%, but they're 80%. And so the market has a couple of different ways in which it could do it. It could break through, retest this, go straight up. It can go straight up, or it could potentially pull back to the moving averages and go. Those are kind of the 3 different ways that it can do it. And so what it's done here is it's completed, in my mind, a minimum retracement requirement to continue up. It doesn't mean that it's going to succeed and go. What's actually happening right now is that buyers are coming in because they're keen to get in, and they're coming in at the very first, earliest opportunity for it to resume. But if there aren't enough buyers above this point, it's not going to grab, take hold, and go. And what could potentially happen then, ideally, I think, is to come down to this level and then carry on up. So those are 2 high probability scenarios in this case. Could it come back below this level? Yeah, it could. There's another level here. It could. Currencies can do that. Come back to that and do that. You'll often see, if you look at trend lines in currencies, and I don't use trend lines, but I know this because I used to use trend lines. When you have a trend line, you'll often see that, okay, so sorry, wrong one. Let's just go with this quickly. Let me just correct that. It's not me, it's Camtasia. So you'll have a trend line, and what you expect kind of currencies to do, because you think they behave like every other instrument and they're kind of different, is you expect them when they're kind of to behave that way. And currencies can do this. They'll break through that and then just carry on. So now you've kind of got to readjust your trend line, or then they'll do this and break through it, and then they'll come back that way and they'll carry on. So trend lines are with currencies at any rate, I don't think are ideal. That is a personal comment. Okay, it's based on experience. It's not random, but because that kind of behavior to me is very common with regards to trend lines and currency pairs. So that being said, it is possible for it to come down here, but I think the most likely scenarios are firstly either there, so it's either going to turn and head up here, and I'm not in it because I'm not trading this patch because that's stupid. Okay, that's stupid. It's a high probability of losing money. I want to trade with it. It's been trending. I'm looking to join the trend once it resumes, but I'm not convinced it's done enough of a retracement. I'm a big believer in Fibonacci, pivot levels, and just normal healthy retracements, and therefore a retracement a bit further down could be cool. Down to this level would be amazing. It would be very convenient. It would be very clean, and it doesn't have to be clean, but that would be great. Highlighted that. So what I want you to take note of before we kind of wrap up, it's 30 minutes running this video, but it is meant to be something I only have to do once, and it should be pretty good, is I want you to take note of price action here. So what does the price action there look like? What does it look like? Does it look like it's attempting to go and getting kicked down again? Does it look like it's struggling? It's very spiky to me. It's got a lot of rejection would be the way to put it. So it's got a lot of rejection there. And it even has rejection today. Okay, so it's now 6 o'clock in the evening. It's got rejection today. It's got a lot of that there. What does that tell me? Well, it tells me that, okay, here it was overpriced. As it came back down and tried to go back up, it's still, the market is not ready. And today, so far, the market's not ready. Now, what could happen is tomorrow it could take off. That's possibility. I'm just saying to you that that price action is communicating to me that it is not actually quite happy with continuing on. Therefore, this is still, therefore, a possibility, but we'll know tomorrow. Excuse me. So how will I know when it's ready to go? I'll know because on the lower time frames, the price action will start to behave in a more orderly fashion. What we don't always realize as newer traders is that well-behaved charts attract the best traders. And the best traders are systematic and cold and robotic in their behavior. They're calm, they know what to do, and their behavior is rational and organized. So when you see a chart behaving in a very organized fashion, it's usually not the retail traders doing it. It's usually institutional, experienced, calm, senior traders doing it. And so that's the difference between a trend that looks like this and maybe a trend that's kind of looking like this, which would be dollar yen, which nobody in their right mind should be trading at all, including hedge funds, including banks. No one should be touching dollar yen. It's junk. And that's, again, is a personal opinion. Okay, I'm happy to have personal opinions here, but I want to differentiate with respect to my mentors and idols with respect to their teachings versus mine. I'm quite happy to do this. I want to be more of the, I'm not even going to finish that sentence, but my approach to the markets, I want it to be more organic. Okay, so basically, this is what I'm looking for. So why does this matter? Well, if we then go and have a look at this, if I do mark it out and I say, okay, what's going on here? Because if I was only an intraday trader, and I'm just going to mark this area, if I was only an intraday trader and I was operating on the 5-minute time frame during that period, what would the last couple of days have been like for me? What would that have been like? And here you can see that, largely speaking, probably wouldn't have been that good. Okay, so again, I'm just going to go up to 5 days. Let's just do that. So we can see here that it's actually been incredibly choppy and volatile with a couple of trading opportunities. Then it reverses and then it moves down, and there doesn't really appear to be a long, sustained or longer term behavior to it. And that is really in part, let me explain why. There's a very practical explanation for it compared to what we were seeing before that. When you have a strong trend, you have more people in agreement about where the market's going than you have kind of against it. And the problem is that when you have a retracement, which is kind of a consolidation or a correction, at that point you have all the people who've been making money and who are still of the belief that the longer term or the next phase is going to be the same as before. They keep wanting to get in. They've either taken profit or they wanted to go. And so you've got this restlessness that happens because everybody's kind of taking a bit of a breather. But a lot of the people who've kind of been on the move from the beginning want to go again. They keep wanting to go. And you've got other people who are coming in late. So you've got a lot of stuff happening. But at the same time, we've got other people taking profit out the market. So you get this. So during that period of retracement or consolidation or correction, it's messy because there's a different strain or collection of activities happening than when the market's moving. When the market's moving, you're either buying or selling, you're getting on the train or you're not. When it's in this period, you've got bit of chaos because most people kind of chomping at the bit, to go again, and the market isn't really there. So the market will trend down, then go up a bit, then have a false start, then kind of fall back again. And actually, it's the higher time frame that says, well, actually, it needs to come back to the moving averages, or maybe it needs to come back down to this fib level, or maybe it needs to come back down to this support level before it's ready to go. And actually, while we're on this, and then I'm going to do this, and I'm going to wrap it up, because let's go and have a look at the US indices right now, because this is relevant. So I'm just going to get rid of that. Let's go look at the NASDAQ. So here's the daily for the NASDAQ. These two areas highlighted in orange are two different support zones, resistance zones that could be support zones. So the larger one is really to do with these three highs, that high plus that high, there's a high there plus that high. So that effectively, I included that, but actually there was a lower high here, so I've included this area as a potential zone as well. Okay, so to me, in my mind, if it's going to break out of a zone, a range, then it can come back to test it, and I've highlighted that. And beautifully, it has produced today a bullish candle right within the zone within the zone. So it's kind of done it, it's ticked both boxes. And so it's produced a bullish candle. It is trending up, and this is now a sign that the buyers have re-entered the market. As far as they are concerned, they have now met the minimum requirement for the daily to have a bit of a correction, take a bit of a breather, take some profits for whatever reason. Now, if tomorrow we follow through, which is Friday, we carry on up, then we've met the minimum requirement. Now, all of that is good and well, but unfortunately for the newer traders, it's not sufficient to just know what's going on in the daily. The daily in isolation today, right now, as you look at it right now, which is the 10th of December, 2020, it's telling me tomorrow it's going to try and go higher. In isolation, what I'm seeing here without looking at any other time frames tells me that it's had a good correction, very much overdue, and it's now ready. Tomorrow it's going to try and break the high, it's going to try and carry on. How do I know that? Well, that's experience and training and education. But that is not all the information that I need to have. And this is a separate video entirely. It's a separate series of videos, but I need to know, okay, so where is the NASDAQ in relation to kind of the bigger picture? And so the problem we have is that on the monthly, the NASDAQ is very, very far away from true value. So we are at risk in the bigger picture over the next 6 months to the next year, absolutely 100% guaranteed, that's experience talking again, of a correction. Probably down to 10,000. So let me sum it up. At some point in the next 3 to 12 months, we are going to have a correction down to, I think, 10,000. At least. And that's coming. There's nothing we can do to stop it. The question is it going to happen now? Or is it going to happen at a later stage? I think the minimum requirement, again, the minimum requirement for retracement, puts us at about 10.6. But I think 10,000 is very fair. 10.6, 10,000. And so that's the issue we have. So if we go back to that daily, yes, the market on the daily in isolation is good to go. But we need to be aware that on a much higher time frame, the bill is coming due. We're going to have a correction. And it's not so bad. It's going to be very scary in the news when it happens. It's going to be very scary for traders when it happens. Everyone's going to be panicking, but it's only down here. It's not so bad. And actually, if it happens, it'll probably come down in 7 or 8 days, less than 10 days, and probably recover within about a month or two. So it's not so bad. And then at that point, it can carry on for 6 months or a year. So we need it to happen. I'm just drawing your attention to that. So this is for individuals who are trading one or two instruments who are looking at the lower time frames. Are they aware of what's going on the daily? My dog's going off. Are they aware of what's going on the higher time frames? You need that awareness, and that context is really what it's about. That's it. So, ladies and gents, I'm sorry that's now 39 minutes. It's a very long video. I really apologize, but I'm hoping that there is some good content in this and it's of value to you, especially the newer traders, or that it fills a gap, just something that you weren't aware of. If you enjoyed it, please let me know in the content, in the description, in the comment section. Also, if you want me to do a particular topic, put it in the comment section. Okay, I'm pretty good. Within 2-3 days, I usually respond to that. And anything else that you kind of want to communicate to me, just put in the comment section and I will have a look at it. And there we go. If anyone's interested, that was all being done on ProRealtime. I use a number of different platforms, but I love ProRealtime. It reminds me of eSignal, and I used to use eSignal and TradeStation. Obviously, I use MT4 and MT5 because I have different fund accounts with those different things. And obviously, there's like TradingView. There's a whole variety of stuff. But that was ProRealtime if anyone wants to know. And that's it. I'm going to end this here, but thank you very much. And part 3 will be out tomorrow.